Hello, everybody. Lavelle with London Bridge Group getting back with you regarding the Tax Cuts and Jobs Act of 2018. I want to go over some numbers with you, and there's going to be a lot of numbers, and I will try to keep it as simplistic as possible. There are a lot of numbers again to go over. So, as I said earlier in the previous video, that we would kind of address who benefited, who do not benefit, and most importantly, what the changes were. So, without further ado, we'll do the easy one first. Obviously, the corporations benefited from the Tax Cuts and Jobs Act simply because their tax uh, percentage went from 39.6% or a maximum of 39.6% down to a flat 21%. And we kind of went over that last time, but just a quick recap. If there was a business that had a net profit of say $1 million, they in 2017 were paying say $396,000 on that, or 39.6%. With the Tax Cuts and Jobs Act, that was reduced to a flat 21%, or $210,000 per million, which is a difference of about $186,000. So obviously, the corporations benefited from the Tax Cuts and Jobs Act. So the other way that we're going to go about this is we'll just go by filing status and kind of throw in some different things that went away. So for example, 2017, if your filing status was single or married filing separately, your standard deduction was $6,300, I believe. $6,350, excuse me. So with the Tax Cuts and Jobs Act of 2018, your standard deduction went from $6,350 to an even $12,000. Now that's a difference of $5,650. However, you were no longer able to get the benefit of claiming yourself as an exemption, which was a total of $4,050 for 2017. So you had benefited in the one capacity, whereas again, you went from $6,350 up to $12,000, which again was $5,650. But then you have to reduce that additional $4,050 off as an exemption, which takes it down even less as far as what you benefited. However, you did still benefit if you were single, married filing separately, and you did not itemize or hadn't itemized in the past, and you did not have any employee business expenses. Okay, so we'll go over employee business expenses really quick. With the Tax Cuts and Job Act, the 2106 form, the 2106 form, 2106 form, employee business expense form, was removed from allowing you to deduct from your taxes, meaning you could no longer deduct employee or unreimbursed employee business expenses. So what this meant is that if you were required to use your cell phone, if you were required to pay union dues, if you had any outside unreimbursed employee business expenses like mileage, meals, even if you work from home, as of 2018, you were no longer, and currently you are no longer allowed to write those things off. So that was a huge difference in the capacity of what you were able to deduct versus what you were not able to deduct, because in some instances, your employee business expenses may have been in the range of 10, 15,000, possibly more, depending on the line of work that you're in. So we're not touching too much on that because we're basically doing standard deductions. But again, if you itemized and you lost that, you have to factor that into what you no longer were able to deduct. So again, single and married filing separately, $6,350 went to $12,000, and you are no longer allowed to claim yourself as an exemption or a dependent, so you lost the $4,050. So again, you were still benefiting. If you had employee business expenses in the range of the 10,000, 15,000, whatever that amount was, well, then you were not a benefactor. This actually hurt you because you were no longer able to deduct that. Okay. Married filing joint, your standard deduction was $12,700 in 2017. With the Tax Cuts and Jobs Act, your standard deduction went from $12,700 up to $24,000. Again, a benefit. 12,700, 24,000, so it was $11,300 that you had received, or say that you were able to write off in addition to what you were writing off the prior year. However, again, You cannot deduct or claim yourself as exemptions or dependents, meaning you lost 4,050 for yourself and you lost 4,050 for your spouse, which was $8,100. So in your case, whereas we had again a benefit of 11,300, you got to take out that 8,100. So now we're down to about $3,200. Again, you did benefit, provided you had no employee business expenses, because that was also taken away. So again, if you work from home, if you use your cell phone for business, if you use your vehicle for business, if you had meals or had business lunches and things like that that you used to be able to deduct as an unreimbursed employee business expense, you no longer receive that. So again, it probably didn't benefit you, and not probably, but it did not benefit you. Now, before we go further, let's add dependents into the equation. If you were married filing jointly and you had two additional dependents, well, again, that's exemptions that you cannot write off. So that's an additional 4,050 per exemption or per dependent. So now instead of 8,100, we have 16,200. Now it's actually costing you more, or you're not going to have the same results on your tax return because you've lost more than what you gained. Again, we went to 24,000, but think of it in this capacity. If you were already getting a standard deduction of 12,700 and you had an exemption of 4,050 for each kid, or for yourself and your dependents, wife or spouse, and your, say, again, in this scenario, two kids, you had 12,007 plus $4,050 times 4, which is 16,200. So 12,7 and 16,2 is going to be 28,9. So now you had 28,9 and now you're reduced to just 24,000. So you lost about 5,000, not to include employee business expenses. Okay. And again, I know it's a lot of numbers, but I just want to kind of give you a update as to what's already in place versus what may or may not come. So moving along, head of household. Head of household standard deduction was $9,350. So that's a person single with a dependent, their child. Okay, so they had 9,350, and their standard deduction with the Tax Cuts and Jobs Act was increased to 18,000. So again, that's 8,650. However, if it was just you and one child, so two exemptions, you lost 4,050 times 2, which is 8,100. So the 9,000 you gained less the 8,100 that you lost puts you just over, say, 1,000. Okay. If you had more children, for each child, continue to add your exemptions. So you got, let's say if it was a single parent and 3 children. Now again, that's the same 16,000 that, say, the married filing joint couple had with the 2 dependents. So you lost that. If you factor in, if you were one who was claiming employee business expenses on your 2106, then you lost again an additional, say, 10,000 or whatever amount that you were claiming. So that's the gist of that. All right. So again, we went over single and married filing separately, what that standard deduction was. We went over married filing jointly, and we also went over head of household. So let me give you some examples. Simply put, as an employee, losing employee business expenses, you are going to not have the same results on your tax return because you were not able to deduct as much. So for example, our first responders, they are employees, so they cannot write off their masks. They can't write off their cell phones when they're on call. They can't write off their scrubs and things like that because they're employees. So you can no longer write that off. You lost that due to the Tax Cuts and Jobs Act. The same with our police officers and firefighters. You can't write off your union dues. The firefighters can't write off the fees for the meals that they have while they're overnighting at the station houses. They can't write that off anymore. You can't write off any additional equipment, any additional, say, weaponry, flak vests, any of that stuff. As an employee, you lost the right to write all of that off. Back to our first responders. We have to wear masks now, or the PPE gear and equipment. You as an employee cannot write that off. Those of you who are working from home, you used to write off again, say, a home office as an employee. You can't anymore. So those are the things that the Tax Cuts and Jobs Act that's already happened. And what you want to be clear about is, again, with the concerns of taxes being raised and all of that, your taxes don't have to be raised by them putting you in a higher tax bracket or a higher percentage. If things that you could deduct is now taken away from you, that's also going to raise your tax liability as well. So again, just wanted to make sure that you were aware of that. I know it's general information and it's not a one size that fits all, because again, we have several scenarios. Again, the amount of dependents, if you were claiming employee business expenses, working from home, first responders, firefighters, police officers, things like that, all of those things factor in. But you want to just be sure that you understand that there's already been some tax implications. So I'm not sure what the new tax implications may or may not be, but we want to be aware of what's going on now. And again, remember that new W-4 that's not new anymore because it came out in January of 2020, that has a factor into how your paychecks are gonna, or what you're gonna receive in your paychecks as well. I hope this has been informative to you. Again, there's not a one size that fits all. So if you have questions, you give us a call, 623-444-8475, or you can send us emails. I'm still old school. Make the phone call and leave a message if you cannot catch us. Okay. In the meantime, have a great day, and we'll continue to post information. And you guys take care, and we thank you so much. Enjoy your day. Bye-bye.